Good afternoon, everyone. I hope you're all good and healthy today. Hope you had a good weekend. So last time I gave you to solve the activities, activity number 6, the questions, the chapter 3 that we covered. However, some of you did not even try to solve. They just copy paste from the solution that I provided in Moodle. And this is not correct. At least you should have tried to solve one question, either using the Excel or your own self, like manually. But I don't accept any activities which is just copy paste from the workbook. Okay, just take it into your consideration. I only accept if you try to solve manually or Excel or in the Word without any copy paste. There should be a proof that you solved it. Okay, let me go over quickly over those questions that you solved it, and I'm going to explain it, and I will let you to solve the remaining questions for activities. For your consideration, please make sure that you solve the questions. For correctness, I'm not grading it one more time. I'm grading it for your efforts that you're trying to put and solve it, not just copy paste. Copy paste is not the effort. Okay. Okay, let me go to the questions. Questions starting from 1 here, we're given. So the cost of equity is equal to the rate expected market return, rate of return required by stockholders, cost of retained earnings plus dividends. So,
Professor, could you show screen?
Didn't I show it? Yes. Again, one more time. My bad. Thank you so much for reminding me. Now, when it says just cost of equity, you should know that it's related to the stockholders. It's related to the shareholders. Nothing to do with the market return, and it's all about the return. If you remember from the slides that we did it, the weighted average cost of capital, it consists of the components like cost of debt, cost of preferred stock, and cost of equity. And the cost of equity is equal here is the rate of return required by the stockholder. So the cost of equity is defined as rate of return that is required by the shareholders. Which of the following statement is correct? The appropriate tax rate to use the adjustment for the before tax cost of debt to determine the after tax cost of debt is average tax rate because interest rate deductible against the company's entire taxable income. This is A. For a given company, the after-tax cost of debt is generally less than both cost of preferred equity is the cost of common equity. So for a given company, the investment opportunity schedule is upward sloping because the companies invest more in capital projects. So the return from the investment increase. So which of the following statement is correct? For a given company, so the first one, the appropriate tax rate to use in the adjustment of the before tax of the cost of debt is to determine the after-tax cost of debt and average tax rate because the interest deductible against the company's entire taxable. This is not correct. This is not correct. And it's not correct because the tax rate which is used in the interest rate and tax rate which is used in the cost of debt is different. For a given company's after-tax cost of debt, and the correct answer, let me just figure out here. For a given company, the after-tax cost of debt is generally less than both cost of preferred equity and cost of common equity. So first of all, when we talk about the cost, you should understand that the cost is measuring the riskness, okay? The cost is measuring riskness, and we are trying to measure which is less costly, okay? And we know that debt generally accepted as less costly than preferred or common stock. And sometimes when I showed you the derivation of betas, the riskness of the equity, I said the beta of the debt is equal to 0. It has a 0 market risk. And that therefore, the debt is generally less costly than preferred and common stock. So the cost of debt is further reduced if the interest expense is tax deductible. Am I recording? Yes. Question 3. Using dividend discount model, what is the cost of equity capital if Zeller Mining, if the company will pay the dividend of 2.3 next year and has payout ratio of 30% and return on equity 15%. The stock price is $45. So here's the key point, okay? You should be very careful when it says next year or just paid. This makes a really big difference. Just paid is the dividend 0. Next year dividend is a dividend 1. So in order to calculate the cost of equity in here. So in order to calculate the cost of equity, first of all, you need to know the formulas that you are given, okay? We know the formulas are here from the book is cost of equity is equal to dividend 1. This is the key point that you should be very paying attention, okay? You should be very careful. This is D1 that I'm talking, okay? D1. If it's just paid here, if in the exam I ask you, please do not solve it like a robot, copy paste from the workbook. Try to read the question. I might change this next year to just paid dividend. So it will not be here D1, but it will be D0. So then you will need to find D1 as well. And divided by P0 plus the growth rate, okay? And the growth rate is equal to 1 minus payout ratio, okay? I will name it as PR, okay? Payout ratio. I will name it as PR. One minus payout ratio. This is in one bracket. And times the return on equity, which is ROE. So payout ratio is given, return on equity is given. We need to find the G. So we just substitute everything into the formulas. We substitute everything into the formulas. In this way, you will get whatever you needed. So G is equal to like 1 minus 30% and times 15%, 0.3, which is 70%. And this all should be multiplied by 15%, which is ROE. And this will give you, if you calculate, 10.5%. 10.5% the growth rate. Now we know D1, we know the P0. Now we can just substitute everything. So RE is equal to D1, 2.3. One more time, guys, I'm telling you, if it's D0, you need to find the D1. And how can we find the D0 if the D1 is not given? D1 times 1 plus G. This is how you find it.
I think it's another way. D1 equals D0 multiplied.
Oh, yeah, true. Then we just divide it here. D1 divided by 1 plus G. If the D1, if you want to find in here D0, that's what you say. That's very good. Thank you so much. I really appreciate that you corrected me. So we are finding D1, okay? Because the formula in here, we're gonna use a D1. If this is D0 as an assumption, so D1 times 1 plus g, and to the power of t, whatever is here, okay, if you're finding this is d0. So this is the way that you find d1 in order to put it here, but in here it's already given as a keyword. It says next year the dividend will be paid 2.30. So you just substitute here 2.30 divided by 45 plus 10.5%. And this will give us, if you calculate, 15.61. And the answer is C. This is the way we find. So be careful while solving the question, read the questions carefully. You can solve it in Excel very quickly. Now, in question 4, .com has determined that it could issue 1,000 face value bond with a coupon rate of 8% paid semi-annually. Be careful. And 5-year maturity, 900 per bond. And .com marginal taxes rate is 38%. Its after-tax cost of debt is closest to, so we need to find cost of debt using the YTM approach, if you remember. It was given in the slides and I tried it in Excel. What do you need to do just to put everything here and just to compute the YTM and convert that YTM into annual basis from semi-annually? That will help you to get a right cost of debt, but then you can take the tax effect as well. So, but why you need to take the tax effect? Because it says, what is the after-tax cost debt? Okay, after-tax cost of debt, not just cost of debt, but it needs to be adjusted to the tax. So what we'll do here, we're given face value as 1,000. The present value we're giving as 900. It's traded at 900. The number of the years, the period is 10 years. And the payment is PMT is 40. And you need to calculate for the rate, okay, for the YTM. And one more thing that make this present value negative, what the Excel requires for the computation. So the rate, number of period is 10, payment is 40, present value is 900, and face value is this. You close the bracket. And this is semi-annual based, but we need to convert into annual basis. So this times by 2. Point. And then, of course, we need to adjust to the taxes. So after tax, it will be equal to this times 1 minus the tax rate is 38%. So after tax, did I do correctly? Yes. So after the tax, the cost of debt is equal to 6.59%. So let's see whether we have this answer. So there is C. If you round it, you're gonna get this one. 59 is 6.6. If you round your Excel, 6.6. 4 is C. So let me erase this all. The cost of debt can be determined using the YTM and the bond rating approach. If the bond rating approach is used, the bond rating approach depends on the knowledge of the company's rating and can be compared with the yields on the bonds in the public market only. So it's companies rated and rating can be used to assess the credit default spread of the company's debt. Yield is based on the interest coverage ratio, no way. And coupon is the yield, never happened. Question 6. Morgan Insurance Company issued fixed rate perpetual preferred stock 3 years ago and placed it privately with the institutional investor. The stock was issued at $25 per share with $1.75 of dividend. If the company were to issue the preferred stock today, the yield would be 6.5%. So the stock current value is equal to, in order to find the price of the preferred stock is basically, if it's a perpetuity, is dividend divided by rate. So the YTM is given, the yield is given, which is 6.5% and 175. So what you do in here is 1.75 divided by rate. That will give you the value of the preferred stock. Simply to say, it will give you the price of the stock, 0.065. And the price will be equal to, you calculate like 26.92. So its answer will be B. Or one more time to you guys, I might rearrange this question in the way that I might ask you not the price, but to find the rate. I will give you the price and everything, but you should find the rate. How you will do it? If we know that the price is equal to dividend divided by rate. If I ask you to find the rate, not the price, you just rearrange it.
Dividend divide by price.
By price.
Yes, very true. So one more time, take it in consideration, please. Read the questions carefully, what you're asked to calculate. It might seem that the question gives you exactly the same in the book, but they are not the same. One keyword might change the whole condition of the question. Question 7, the financial analyst wants to compute the company's weighted average cost of capital using the DDM model. The analysis has gathered the following data: the cost, the tax rate, debt equity ratio, target one, the stock price, the next year dividends, and estimated growth rate. So in here, you need to calculate the cost of equity, the proportion, and cost of debt is given already. So to find the cost of equity is the same thing that we did it in the previous question, is rate of equity is equal to D1 divided by price 0. If this D1 given, if it's not given, you're gonna get it through the D0, if the D0 is given. In this question, D1 is given or D0?
D1.
D1.
D1. Okay, then we don't need to calculate. G is given. Estimated growth rate is 7%. Okay, it's given. We don't need to calculate. Again, guys, I might not give you this. I might ask you to calculate the growth rate as well. Okay, be careful. So you just plug it into the formula, everything. 1.5 divided by price, which is 30, plus 7%. And that gives you a quality of 12%. So the cost of equity is 12%. Now what do you need to, and we know the proportion. Target debt equity ratio is given here. And we know how to find the proportion of debt is debt equity ratio divided by 1 plus debt equity ratio, which is 0.8033 divided by 1.8033. That would give you the proportion of the debt, 0.445, and proportion of equity is 1 minus 0.445, or there's another way of getting it, is 55. Now we know the proportion debt, proportion equity. We know the cost of debt, cost of equity. We found it. Now we need to just substitute everything into formula. Weighted average cost of capital. So if you substitute, the proportion of the debt is 0.44.5 times 8%. And it should be adjusted to the tax, 1 minus 0.40%, the tax rate, and plus proportion of the equity, 0.55 times the cost of equity, which is 12%. And this is equal to 8.8%. And the answer in here is B. So if you just round it up, if you calculate in Excel, it should give you even 8.80 something. Let me do it quickly to you, show it to you. So 0.4045 times 0.08 and 1 minus 0.40 plus 0.55 times 0.12. If you round it, it comes as a 9%. So it's B. Question 8. The gearing company has the after cost of debt capital is 4%, the cost of preferred stock is 8%, and cost of equity capital is 10%, and weighted average cost of capital is 7%. So gearing intends to maintain its current capital structure. It raises the additional capital. So in making its capital budgeting decision for average risk project, the relevant cost of capital should be, so the weighted average cost of capital using the weights derived from the current capital structure is the best estimate of the cost of capital, is the average risk of the project of the company itself, which is 7%. So there is no need any calculation. Question 9. I'm not going to read it, this question, but just directly going with the numbers. So book value of the debt, market value of the debt, book value of shareholders, and market value of shareholders. And you're asked to calculate the weight of the McClure should apply estimating the cost of capital for debt and equity are respectively here. So you need to just estimate the proportion debt and proportion equity, which is if you're going to estimate the proportion of debt and equity, here the numbers that you're gonna get it, it's if you're doing the debt is debt over debt plus equity, so which is $63, the first one, divided by 220 plus 63. And we're using 200, the another one, the proportion of the equity we can use, if you find it here, the proportion is equal to 0.223. You can do it like equity divided debt plus equity, or doing the same like proportion of equity is equal to 1 minus proportion of debt. Or that I said to you, like equity over debt plus equity. These are the straightforward things. I mean, it's very easy to calculate. So the answer is C. And why we are using the forecasted one, who can tell me? Not the current year's one.
Maybe because we need to find, if we need to find the current year, we need to use like the forecasted year.
First of all, my question to you, why do you need to calculate this proportion? For what? For what are you calculating this proportion of debt and equity?
Or WACC?
For WACC. And why you're using the WACC? What is the purpose of using the WACC? Why do we need to use the WACC? Why we like dedicated one chapter for the WACC? Why there is a need to do it?
To calculate the return.
To calculate maybe valuation.
Where we use this WACC? NPV. We're using an NPV. NPV is what? It's the net present value, the project that you want to run or not. You want to make a decision whether the project is profitable or not. So you're doing estimation. So if you're doing estimation of certain project, it is logical to use the forecasted numbers than the current ones. You need to forecast the numbers in the future because the project is about the future. So you have to use the forecasted information rather than the current information which is given. Okay. Question 10 and 11, they are theoretical one. Okay, let me just go quickly. The wacc security had the long-term stable debt equity ratio of 0.65, and a recent bank borrowing for expansion into the South America raised the ratio 0.75. So increasing the leverage has the what effect on the asset beta and equity beta of the company. So asset risk does not change with the higher debt equity ratio, and equity risk increases with the higher debt. So the answer is B. However, why do you think it might increase? when your debt increases, why the equity risk increases? When you lend the money to your friend, let's say to your closest friend, what is the first thing that comes into your mind? Let me just, for example, Islam.
Yes.
I'm here. If you lend the money to your friend, who is your best friend? Do you have any best friend?
Yes, exactly.
What is the name of your best friend?
Janibek.
Okay, imagine Johnny Bey came to you today and asked you, can you lend me, let's say, $1,000? Would you lend him money?
I don't have $1,000.
Okay, imagine you have it. You have it now.
Okay, yes, yes.
You would lend it. So what is
Yes.
the first thing that will come to your mind when you lend the money?
Will he return me back my money?
Yes, yes, this is what I was looking for. So the best friendship is going to behind of the riskness. So now you don't consider that he's your best friend or no. So the first thing that comes to your mind, whether he will be able to return the money back or not. This is the question rises in your mind, but not only yours, in all companies, in your financial institution. The higher the debt, the higher the risk of default. So increasing in debt, that will lead to increase the equity beta as well. Question 11. Brandon Wynn is a financial analysis covering the beverage industry, and he's evaluating the impact of DEF beverage in new product line of flavored waters. So DEF currently has a debt equity ratio 0.6. A new product line would be financed with 50 million of debt and 100 million of equity. In estimating the evaluation of the impact of the new product line, DEF's value, the Wynn has estimated the equity beta and asset beta for comparable companies in calculating equity beta for product line. So Wynn is intending to use DEF's existing capital structure when converting the asset beta into project beta. And which of the following statement is correct? Using the debt equity ratio of 0.6 is not appropriate, but raising the debt equity ratio of the new product is 0.5 and is appropriate to use it in calculating the new product line's beta equity. And how do we know that this 0.5, where it comes from?
From formula MV
Yes,
debt
yes.
divided by MV debt
Yeah,
plus
50
equity.
divided by 100. 50 divided by 100. Okay, question 12. The Trumpet Resort Company currently is 1.12 million. Common shares of the stock outstanding and stock has beta of 2.2. It also has 10 million of face value of the bond, and that have 5 years remaining maturity and 8% coupon with a semi-annual payment. Price at yield of 13.65%. So if the Trumpet issues up to 2.5 million of new bonds, the bond will be priced at par and have the yield of 3.65%. And if it issue bonds beyond the 2.5 million, expected yield on the entire issuance will be 16%. So the Trumpet has learned that it can issue new common stock at $10 per share. The current risk-free rate of interest is 3%. The expected market return is 10%, and Trumpet marginal tax rate is 30%. If the Trumpet rises to 7.5 million of new capital while maintaining the same debt equity ratio, its weighted average cost of capital is closest to, now we need to calculate weighted average cost of capital. But before that, we need to calculate all the information before calculating. So we need to calculate the cost of debt. We need to calculate the cost of equity, but there is no need for cost of preferred stock because there is no any preferred stock issue. So market value, first of all, of the debt, we need to just put everything into money that we can really read it, everything. Let me just put it here. So the capital structure is the following. The market value of the debt, face value is equal to 10 million. Or it's 10,000, okay? It's given always. Let me dollarize it. Then payment, we need to calculate. So 5 years remaining to maturity and 8% of coupon with a semi-annual payment. What is the payment equal to? If we know that the face value is 10 million.
4% multiplied by 10 million.
Why 4%? Why not 8?
Because it's we convert to semi-annual. We divide by 2 payments.
Very good. Very good. Thank you so much. Very good. And number of the period is 10 years. Then we have YTM is equal to 13.65%. And if you want to find present value of the bond, rate, which is given here, number of periods, payment, and face value. And we'll get the negative number.
Shouldn't we divide YTM by 2?
Yes, very true. This is what we should do it as well. But let me make it like this. Put the negative sign here. Okay. And the market value of the equity is 1.2 million of shares, which is outstanding. Market, I'm just going to abbreviate it, market value of equity is the new common will be issued by $10 per share, and the company currently has got 1.12 common shares outstanding. So which means 1.200,000 times $10 per share. So it is 12 million of the market value of the equity. 12 million of the dollar, okay? And this is present value of debt, or we can call it market value of debt. market value of equity, and the total value is the asset, okay? Total asset. This plus this. And in percentage, the proportion is the how you get it. Like almost half, which is, if you calculate this divided by this. So this is the percentages that we have it. In total, of course, they make 100%. Okay, now let me read the question. I'm a bit lost. 2.5 million of new bonds, and if it issues. So, if Trumpet raises 7.5 million of new capital while maintaining debt equity ratio, and its weighted average cost of capital should be equal to. So our cost of debt should be. So we will raise 7.5 million of new capital while keeping the same capital structure. So the company would issue 3 million in bonds, which results in before the tax rate in order to keep like same capital structure. What I mean by keeping this capital structure same, like 40 to 60. How much of debt should be? So our job is to increase to get the money of 7.5 million, but we need to increase debt and equity in the amount where the capital structure will not change. So if you want to raise 7.5 million, that means that 7,500 times this much of, it's almost 3 million, but anyway. So the percentage, so this much should be issued through the debt, and this much should be raised through the issuance of equity. Let me check my cost of debt. 16% is expected yield on entire issuance, the cost of debt, but it is before. Now we can calculate cost of equity and we can calculate cost of debt. So cost of debt, cost of equity. But make it like this, it's already given, 0.16, and cost of equity, risk-free rate using the beta, and risk market premium plus risk-free rate, that using the CAPM model. So we will calculate everything through the CAPM. Beta is 2.2, and risk-free rate was 3%, something I remember here. Risk-free rate is 3%. And the expected market return is 10%. Okay. So which means 0.03 plus 2.2, 0.10 plus 0.03. That would give us.
I think we should deduct, no?
Sorry?
We should deduct in the right side, yes. Minus.
Yeah, I agree. I just, because we're getting the equity risk premium here. It's a difference between the market return and the risk-free rate. These are the percentages. Now we can calculate the WACC.
Professor, why we didn't apply tax in RG, or we don't need it?
Not yet, not yet. We are going to directly apply the formula which is given. And the formula is given here. Let me just remind you again. You can apply it, but
Yeah, I get it. I get it. Okay,
I
okay, get it.
prefer to use it directly in the formula. I am preferring to use it directly in the formula.
Yeah,
But
I
if you
understood.
apply it, that would make your job a bit easier, but not that much anyway. So we have proportion, which is 40% times this times 1 minus the tax rate is 30%, and plus proportion times cost of equity. So it's 15.5%, 15.52% of weighted average cost of capital.
Professor, why did we find this 3 million, $4.5 million?
Sorry, one more time.
Why did we find this 3 million, $4.5 million?
This one. This
Yes.
I showed you. The aim was what? To keep the capital structure same, 40 to 60. So the question was said that you need to raise this. Trumpet would like to raise 7.5 million, okay, of capital. They need this money. You can do it through debt or equity, or you can do it both. If you're doing the both, you should keep in mind, you should maintain the capital structures in the same level, like 40 to 60. Then, which means how much of debt you need to raise and how much of equity you will need to raise. Even though we don't need to calculate, I'm just showing you in terms of money. Okay, I just showed you, like at the end, we will need to get $7.5 million, okay? How you will get it? You will get it through the issuance of debt, through the issuance of the bonds, and through the issuance of equity, which is 4.5 million. But in calculation, we don't use them. Just for clarification, I showed you here, okay? To show you that the proportion of the debt is the same. How
Okay,
do I know it's same? This divided this, which is 40, and this divided by this, 60. Okay, great. Question 13. Okay, this information is given, and I'm not going to read it. I'm just going to directly through the question itself. All the information provided, and you're asked to calculate using the capital asset price model, CAPM, find the cost of equity capital for typical project. Okay, we need to use the CAPM model. Okay, it's just straightforward. You just get the numbers from here, like risk-free rates. Then you use the beta. Where is our beta? Here, 1.3. And market premium, interest payment by year, and corporate tax rate, country risk premium. We don't consider it. We are just using the CAPM for not considering country risk premium. And equity risk premium is here. Okay, it's directly given. You don't have to calculate. You don't have any subtraction. It's directly given. So you need to just substitute into the CAPM model, which is 0.0425, which is risk-free rate, plus 1.3 and market risk premium, which is 4.8%. And this is equal to 10.5% B. Sandel is interested in the weighted average cost of capital, KRUSPA, maybe, and it's investing the China's project. So weighted average cost of capital is closest to here. So we need to calculate in here cost of debt. We need to know what is the cost of debt. We'll get, everything is given here, okay? Still, you're just substituting everything into formula. Proportion of debt is given, and proportion market value of debt, market value of equity is given. You need to just substitute the numbers. That's it, into the WACC formula, which is 900 divided by 3,300 will give you proportion of debt times 9.25%, and you adjust to the tax, and plus 2004. Let me do it in this way more quickly. So 900 divided by 3,300, which is proportion of debt, times the cost of debt, which is 9.25%, and you adjust to the tax. 1 minus 0. The tax rate is equal to, in this case, 37.5%, and plus, and proportion equity 2,400 divided by 3,300 times cost of equity, which is, we found it above, 0.1052, and that would give you the WACC 0.0923. Which is B. So this, if you know the formulas, if you know the meaning behind the numbers that you're using, you can easily calculate very fast and you get the numbers. In question 15, like the asset beta of KRUSPA based in his calculation, so estimated asset beta for KRUSPA prior to China project is closest to. So we need to calculate actually asset beta or unlevered beta. We need to just substitute everything into the formula as well. If you calculate the unlevered beta, let me just quickly do it. In here, you're just doing the straightforward plugins. So you get the numbers and substitute, and you get everything. So unlevered beta is equal to 1.3, the levered beta equity, divided by 1 plus 1 minus tax rate, which is 0.375, times debt equity ratio, and debt equity ratio is 900 divided by 2,400. 900, 2,400, and of course it should be in bracket first of all. The bracket, it plays a very significant role in here in order to get it correctly calculated, everything. So everything is calculated now. You can just easily calculate the unlevered beta, 1.053. And now this number will be used in project things here, because now we calculate the unlevered beta. Now we can use project beta, okay? Project beta, which is unlevered beta that we found it 0.53. Now the debt equity ratio changes in here. It says that estimated project beta for China project, if it's financed 80% with debt and 20% with equity. So 1.53 times 1 plus the tax issue, which is 1 minus 0.375 plus What plus? I don't put any plus.
Multiply.
Multiplication, which is 80%, which is, let's say, 80 divided by 20. That will give you the debt equity ratio directly. So which is equal to, if you calculate, that will give you 3.686. And question 17, you're asked to calculate. So these questions are all correlated, okay? They're all correlated. They're coming as a one big question. So a part of sensitivity analysis, the effect of the new project company's cost of capital. Sandel is estimating the cost of equity China project, considering that the China project requires the country risk premium to capital risk of the project. So the cost of equity for the project in this case is closest to, now we need to find the cost of equity itself using the CAPM model. So we'll substitute everything into the CAPM. So risk-free rate given, the project B beta is founded, and country equity premium is given as well. So we need to consider country equity premium to capture the risk for the project as well, okay? So everything is given. I'll put it here. So if you find cost of equity, which is risk-free rate, 4.25%, plus beta, 3.686 times equity premium, which is already given, calculated above, 0.482, sorry, 482. And we need to take into consideration the country risk as well, which is given as well in the table. It's 1.18%. And this is equal to calculate. Did anyone calculate? Just a second.
28.95%.
28.95, yes?
Yes.
Okay, 28.95%. So this is how you find it. Okay, C. Now we are coming question 18, which is a bit comprehensive, that you need to calculate the cost of equity on one side. So in this report, the Sandel would like to discuss the sensitivity of the project's net present value to the estimation of the cost of equity. China's project's net present value calculated using equity beta without and with country risk premium are respectively. So net present values are using the equity beta, without and with country risk premiums are here. So without and with 26, 28, 30, and 27. Now, cost of equity without country risk premium. Let me just type it everything here. So cost of equity without country risk premium, without country risk premium, which is equal to we just find it through the kappa model, 0.0425 plus 3.686 times equity risk premium, which is given above as well. And this is 0.482. And this will give you without country risk premium. We said we already calculated with country risk premium, but now let's see let's compare what will be the weighted average cost of capital. To calculate, and it should come as 0.22. Sorry, my computer stuck. Now we are going with the cost of equity with country risk premium, which is the one that we calculated, 0.2895. So this is we found it. And what do you do here, guys? First of all, you should calculate in here, you're asked to calculate the NPV. NPV using different WACCs. The WACCs with considering the country risk premium and the WACC considering without country risk premium. And the cash flows are given above. I'll go back to those cash flows. So your job in here is to find the weighted average cost of capital with country risk premium and without country risk premium. So the WACC in here for the without country risk premium is equal to, if you consider same proportion of the debt, 80 to 20 times 0.0925, and it should be adjusted to tax rate 1 minus 0.3075 and plus 0.20. 0.2202. That would give us without country risk premium, and it will be equal to 0.0903. And the WACC, let me put it like this, without, so that we can differentiate and with. So the WACC, I almost use the same numbers here, with one differentiation, 28.95. And the WACC with country risk premium, 0.1042. The logic behind this here is that, guys, the more risk is considered, the more compensation is required. This is what the WACC tells you. Okay, the more risk you take, the more you should be compensated with. That's why it gives you the WACC higher than here. So, and with the country risk premium, the NPV is always lower because of the WACC. So we know there is an inverse relationship between the WACC and NPV values. So this is what we calculate, the WACC. And now what you need to do, so let me just memorize it, this screenshot, okay. Close it. Now we can go back and see the cash flows, okay. Now the cash flows are here, okay. Now we need to read everything. It provides the concept with the basic information. Groups a global annual free cash flow to the firm 500 million. and earnings are 400 million. So Sandal estimated the cash flow level of a 2% rate growth, and Sandal also estimates that Kruspa after tax-free cash flow to the firm on the China project of the next years, respectively, 48 million, 54.4 million, and Kruspa recently announced a dividend for the on per share. Okay, we don't need it. So the cash flows are given here. So what do you need to do? You use the wacc. You use the wacc rate to estimate the NPV, and whatever you get it here, question 18, it will be C as you calculate the NPVs. Okay, I'm done for today. I will take the attendance
Sorry,
now.
may I ask?
Yes, please, surely ask.
Regarding this last question, so when we calculate NPV, we use R, yes? And we just change this R to WACC
Yes,
with and without.
yes, very true, very true. Let me take the attendance and I'll let you go. Okay, Sanjar is here.
Yes, I'm here.
Islam, he was here. Islam,
Yeah, I'm here. I'm here.
Aidai,
I'm here.
Yasmin,
Here.
here. Jean,
Here.
Niva, Nias,
I'm here.
Tomiris,
Here.
Yerzat,
I'm here.
Gablugani,
I'm here.
Raushan,
I'm here.
Binura,
Here.
Aidana,
Here.
Begzat, Begzat. Okay, whoever I read the name, you can leave it. Zirui,
Here, I'm here.
Sultan, Sultan, Daujan, Eldar,
Excuse me.
I'm here.
yes,
Begzat
Eldar
is here.
here.
Eldar here.
Yeah,
I'm
Eldar
here.
And Begzat is here.
Begzat, okay.
Excuse me.
Okay, no problem, Begzat. Aidos, Aidos, not here, okay. Gani, Artur, Baglan,
I'm here, Professor.
Zarina,
I'm here.
Abdurrahim,
Here.
Raihan,
I'm here.
Alibek,
I'm here.
Danyar,
I'm here.
Sanjana,
I'm here.
Dalerhan,
Here.
Baglan, Kleshov,
I'm here.
Milana,
I'm here.
Arnur here,
Here.
Iliad,
Here.
Daniel,
I'm here. I'm here.
okay, Umar, Vladislav, Umarov Vladislav,
I'm here.
okay, Diana,
I'm here.
Clementi,
I'm here.
Janelle, Camila, Adilhan,
I'm here.
okay, Adilhan is here. Okay, thank you so much. See you on Wednesday.
Thank you, Professor. See you.
Bye. Take care, guys.
Bye, Professor. Thank you.